In addition to the favorable changes made by the CARES Act to qualified improvement property, as Paul explained, and the business interest expense rules that Mike just talked about, another taxpayer favorable provision of the CARES Act is the change it made to the treatment of net operating losses. So just go backwards for a minute. The Tax Cuts and Jobs Act had changed the rules related to NOLs incurred after 2017 in two unfavorable ways. It prevented the carryback of an NOL that arose after 2017 so that they can only be carried forward. And it limited the amount of income that taxpayers could offset with an NOL incurred after 2017 to 80% of taxable income. The good news is the CARES Act alleviated these limitations for NOLs incurred in 2018, 19, and 20. For NOLs arising in these years, 100% of such losses can be used to offset taxable income. So the 80% limitation is gone. And these losses can now be carried back for up to a period of 5 years. These rules apply to individual taxpayers, trusts, estates, and corporations. The ability to carry these losses back is very beneficial for a couple of reasons. Not only does it enable taxpayers to receive refunds of taxes previously paid, rather than having to wait to reduce future taxes, but carrying these losses back is more valuable from a dollars perspective because tax rates were higher in those years than they are now, which means that every dollar of deduction results in a larger benefit. It is clear that there will be many taxpayers with losses in 2020. However, these rules apply to losses incurred in 2018 and 19 also. For that reason, it is important to check two things. One, did you have a net operating loss in 2018 or 2019 that you thought you could not carry back? And two, are there provisions of the CARES Act that would enable you to amend your 2018 or 19 tax returns and create a net operating loss? For example, the technical correction to the qualified improvement property that Paul spoke about will cause assets that were placed in service in 2018 and 19 and previously depreciated over 39 years to be 100% currently deductible using bonus depreciation. And as Andy explained, taxpayers can either amend their 2018 tax returns to reflect this change, or they can take the benefit in 2019. They don't need to wait until 2020 if they don't want to. In addition, the limitation on excess business losses was removed for 2018, 19, and 20. So taxpayers that were subject to this limitation may end up with a net operating loss after the limitation is removed. I would highly suggest reviewing your 2018 and 2019 tax returns, if 19 is filed already, to determine if you can benefit from any of these and other changes. However, it's not an automatic decision to simply carry the loss back if you have one. There are some other factors to consider in determining whether it might be better to carry it forward. David Seiden spoke about one of them earlier, state tax considerations. Carrying the loss back for federal tax purposes may result in a loss of the benefit on the state side. Also, if a taxpayer was in a lower tax bracket in prior years, it might be better to carry the losses forward to a year when they'll be in a higher tax bracket. So how do you carry a loss back? Well, there's a specific order that you must follow. You can't just pick and choose which year you carry back to. You must go to the oldest year in the carryback period first, then the next oldest year, and so on. So for a 2018 loss, it must first be carried back to 2013. Then after you've offset all your 2013 income, it goes to 2014, then 15, and so on. 2019 losses must first go back to 2014. In terms of what forms to file, there are two choices. There's the quick refund option on Form 1045 for individuals, trusts, and estates, and Form 1139 for corporations. If you can't use these forms, then you would have to file an amended tax return for each year that you are carrying the loss back to. So the quick refund applications are a much better route for a couple of reasons. They allow taxpayers to get the refund quicker than if they filed an amended return. And it is a much more efficient way to carry back the loss, since you can offset income for 3 years on one form rather than having to amend 3 separate years worth of returns. However, there's a due date for the quick refund forms. They must be filed within 1 year after the last day of the year that the NOL arose. So for losses arising in calendar year 2018, taxpayers would not have been able to use these quick refund forms because they would have been due by December 31st, 2019. Thankfully, the IRS issued some guidance last week to address this and a few other issues that got created as a result of this new ability to carry losses back. So even though the CARES Act allows for 2018 NOLs to be carried back, the Act did not provide additional time to file the quick refund applications, even though the due date for the ability to do so had already passed. So the IRS issued Notice 2020-26, providing an additional 6 months to file the quick refund claims for NOLs arising in a tax year that begins during 2018 and that ends before June 30th, 2019. The IRS also announced just yesterday that these forms should be faxed to the IRS rather than mailed. They indicated that the IRS is currently receiving so much mail that the US Post Office can no longer hold it, and that the IRS is actually holding this mail in trailers until employees can get back to work. There will be specific fax numbers provided to use for these filings, which they indicated will be available starting on April 17th. As a result of the ability to now carry back losses incurred in 18, 19, and 20, a few other issues arose that might have caused taxpayers a problem. But the IRS issued RevProc 2020-24 to address and resolve these issues. So what are the issues and how did the RevProc resolve them? The first one is a result of the rule that requires NOLs to be carried back before they can be carried forward, unless an election to forego the carryback period is made. But that election must be made with the tax return that reflects the NOL. So for taxpayers that have NOLs in 18 and 19, if they filed their 19 tax return already, they would not have made that election on those tax returns because at the time they filed those returns, there was no ability to carry those losses back. So there would have been no need to make the election. As long as the taxpayer wants to carry the loss back, there's no issue because they never made the election to waive the carryback period and they're actually required to carry the loss back. But if they want to carry the loss forward, prior to the issuance of this RevProc, it was unclear how or if this election could be made. So the RevProc provides the ability to make this election on the tax return for the first taxable year ending after March 27th, 2020. So for calendar year taxpayers that have NOLs in either 2018 or 19 that don't want to carry the loss back, they can make this election to forego the carryback period for those NOLs on their 2020 tax return. There must be a separate election for each taxable year that there is a loss, and the election is irrevocable. Another issue that arises from this new ability to carry back the losses incurred in 18, 19, and 20 is when losses are carried back to a year in which the taxpayer had Section 965 income and incurred a toll tax that it elected to defer and pay over 8 installments. The reason this is an issue is because when there's an overpayment on a tax return where there are outstanding installment payments due to the toll tax, any overpayment first gets applied to those installment payments before the taxpayer can apply it towards their next year's income tax or get a refund. So in order to help taxpayers get more money in their pockets currently, rather than simply prepaying their deferred toll tax installments, the CARES Act provided taxpayers the ability to exclude any year in which there was 965 income from the carryback period. And RevProc 2020-24 provides that in order to do so, an election must be attached to either the tax return in which the NOL arises, a quick refund claim application, or the earliest taxable year in the carryback period that utilizes the NOL on an amended return. This election is also irrevocable. So if you only remember one thing that I spoke about today, I would say that it is to make sure that you fax your refund claims to the number that will be provided by the IRS in a couple of days, so that your refund request is not sitting in a trailer collecting dust until the IRS reopens their offices, whenever that may be.